Andrew Milligan, Head of Global Strategy at Standard Life Investments, joins us live from Edinburgh. He helps oversee more than $221 billion. Thanks so much for your time. We appreciate it. So where do you stand on the great bonds versus equities debate? What are you buying right now?
Well, my answer to that is simple, which is I'm buying neither, but I'm buying corporate bonds instead, because I'm hoping to get the benefits of both. I thought the previous discussion was quite right and very insightful in terms of some of the issues driving government bond markets, expectations of interest rates lower for longer, and then the possibility of the fabled double-dip recession, and the equity markets being supported by quite good earnings at the moment, particularly from the overseas sector. So corporate cash flow is really very high, and we heard in an earlier piece how some of that's being put to work in M&A, for example. But if you look at the corporate bond markets, they seem to be getting the benefits of both of that. The cash flow is supporting credit, especially high yield, and the reduction in long-term interest rates is of course supportive for the pricing of corporate bonds as well. So I'm not saying that the bond market is necessarily completely mispriced, nor that the equity market doesn't have vulnerabilities, but I think corporate bonds do have some advantages over both at the moment.
Right, so you're investing in the corporate bond market. Tell me more about your strategy at the moment in the current economic environment.
Well, our strategy, and it has really been for the past year or so, and a very successful one, is one we call sustainable yield. We're generally of the view that this is going to be the choppy, volatile economic recovery. The second half of this year looks to be much slower for many countries than the first, for example. And we've got to take that into account in terms of interest rates lower for longer, I mean, quite possibly well into 2012. So where can we get yield and income and some sustainable earnings power? So we're put together a portfolio of consumer bond, credit, corporate bonds, as I just mentioned, but also higher paying dividend equities, and also commercial property. And within equities, there are some sectors and companies that we like, where we see particular business models, whether in financials or industrial cyclicals, that can make some capital growth as well. So a sustainable yield portfolio trying to see through some of the volatility, which we just saw in the markets over the last few days.
Now, Andrew, we've been speaking all morning about a resurgence in mergers and acquisitions. We've been hearing companies sitting on almost $3 trillion in cash are now starting to spend it. Why are we seeing so much M&A right now?
I presume it's because company management feel that the valuations of the shares they're looking for at the moment are reasonably priced. And in some cases, it must be said, they look to be paying quite a hefty premium. And we as fund managers are a little concerned that some of those premiums are so high that some of these deals are not earnings enhancements for a couple of years. And that's a bit of a concern. It's one thing to drive the stock market forwards, and that's helpful short term. We actually do want M&A activity that is helpful, has got synergies, and is not company management wasting money. So Andrew, we're going to be looking at some of these deals a little carefully.
Sure, and the bids that we've been looking at this morning, BHP Billeson's bid for potash and Korean National's bid for Dana Petroleum, both cash bids. Do you think we will continue to see a lot of all cash or mostly cash offers?
I would think that it is going to be a mix of cash and debt. I mean, borrowing costs for companies are really very low on a historical basis at the moment, as interest rates are, of course. And so I'm sure some companies will use a mixture of cash and debt. But I would absolutely agree with you. I think we are starting to see an M&A wave. We've been expecting this for some time, and I think the question lots of strategists had is, why wasn't it happening already? But it does appear to be taking hold into the autumn, and I think we are in for a period of time where M&A is going to be driving selected sectors and perhaps even on some occasions whole stock markets
and very
forward.
Very briefly, Andrew, is the trend likely to continue? Is there some assurance that the economy, that the recession has bottomed out? What are the prospects for a double dip?
I don't see a double dip recession. I do see slow economic growth. I see quite good stock market profits, particularly from overseas and particularly from the pricing power which some people are getting. And I think that's a situation where you hold equities, you buy credit, and you are very careful about government bonds.
Andrew Milligan, Head of Global Strategy at Standard Life Investments. Thanks very much indeed for your time. We appreciate it.